Do you struggle in reading the market in what direction it goes? I'm going to give you a strategy using just a simple square by measuring what the market does. Because very often, check this out, if the market does this kind of movement down, it will do it for once, for twice, and even a third, a fourth, and even a fifth time, as you see here, many times, multiple times in a row. So it's all about reading the market and not actually thinking what we thought from a YouTube video or just any trading book. So first of all, we use the square to determine like what kind of movement did we saw from bottom to top. If you see this kind of movement, then we need to take the square and to check out like what's this movement here having here the same length. As you see, this movement here is smaller, so I'm going to adjust it here so I know that the average of retracement is that small. Because if you just now put it here on the bottom, you can see here the market goes down. On the first retracement, the market does the same length, and just any red candle here up there works, trading down to this bigger structure low. The market always aims for bigger structure lows or highs. This is something what is very important. Like check this out, same movement again, first red candle, second red candle, then the movement works. And this is not only for retracements, this works for both directions. So move for the movement down and the movement back. And what makes more sense now is if you understand that the market is aiming for bigger structure lows, such as here, or bigger structure highs. Sadly, there's nothing on the left side. This will be here, the bigger structure high up here. And you can see the market does a more longer movement down, such as you can see here from here to there, that being here now, in this case, that it makes more sense that the market here, because it does this kind of retracements, that the market maybe does here the same movement, and then the market wants to go down. Sadly, the market didn't do here the movement, but it started to do here almost the same length as it did also up here, as you see there. So using a three-step method, that is what I want to give you, is step number one, identify the bigger structure highs or lows, or something additional is a contraction phase, because on the left side, if you can see that the market wiggles around and you make the 1 minute chart small, such as here, for example, the markets most likely won't be trending up just in a direction. Most likely the market will come back to this contraction phase. So either we can take this contraction phase, I love to draw it like this, taking the highest and the lowest point, and then going 1 point inside here and then 1 point inside here like that. So I have a small average inside and then drawing it to the right side. So either understanding that the market wants to go to this contraction phase, or like when it goes away again, that it goes back to the contraction phase, or just simply what I think is the best thing is literally just to take the biggest structure low, biggest structure high, and to wait until the market is nearby, seeing that it has enough momentum. This is step number two, what we just did with the squares. Another way would be also just to see or to understand that if the market goes down, for example, it will do most likely only 1 or 3 green candles. Check this out. Here the market doesn't go below this low and pushes up. And then the market starts most likely to make not more than 3 red candles. Check this out. Here you see 1 red candle only. Here you see only 3 red candles and a doji. So once the market starts to make the 4th red candle, like in this case, either it goes in a contraction phase, it goes flat, or it changes the trend very often, as you see there. The market would need a lot of more buying power. Like literally when making the chart small, it depends, like for example here, if the market here starts to make 4 red candles because it's that strong moving up, it's totally fine still to assume the market goes up. But if you can see the market is flat, has here a contraction phase, starts to make the first 4 red candles, that's exactly where the market is going to turn around. And then we can use these references. So step number one, we identified where the market wants to go. Step number two, we see more than 3 green or red candles in that direction, and we also measure the length. Keep in mind, we need to measure a lot of squares, like not just placing here 1 square and now just assuming the market will do the same. No, we're going to use our mind. Like we can see this was a long movement here. This was also a movement that had almost the same. But if you just look exactly, you see here smaller movements from here to there, from here to there. So trading these smaller movements is actually more better, as you see from here to there, because when taking these movements into consideration in average, and then we're looking on the retracements, such as from here to there as a retracement, as from here to there more, that it's a minimum. Now, when looking here, we can have the opportunity that when we see the retracement from here to there, for example, in average, Then we assume trading the red candle that it goes down. Sadly, this trade would have resulted in a losing trade when having enough leverage and adjusting $100. But the next trade here, the red candle here, when trading this candle, adjusting $100, can be a winning trade of up to $600 as you see here while risking $100. Quantity beats luck. In trading, it's always about quantity. And we feel sort of anxiety and shame to do bad decisions. And this is something what is totally normal when it comes into trading. That's why it's very important to structure ourselves using one market, one trading strategy, and we build a relationship and we try so good as possible to hold this relationship to the market so consistent as possible. So that's step number 2, right? So step number 1, we identified where the market wants to go. Step number 2, with the measurement, with the 3 or 4 green or red candles. And step number 3 is when we can see that the market does the same retracement as we saw, and we assume that there's a $500 or $600 movement, then the question is always, how can I risk only $100 or maybe $50 to get $500 or $700? And this is the risk reward. And the solution to that is for me just to take a 1-minute chart. Just any red candle or any green candle will do. Especially color switches are very powerful. Check this out. If I, for example, take this square here and assume here the retracements will be the same. Now we have here a green and a red candle. The next green and red candle is here. And you see the difference here is that the next color switch makes a very long red candle here. So when adjusting here $100 like this, that's too much risk. But it's because of the movement, like if we see only that kind of movement, there is no risk reward ratio of 5. This is something what's very important for me. That means if I place $100, I want always to have $500 out. That's only possible within these small color switches, so I would lose money in this case. But then if we look again at the market, that the market does, for example, like these kind of retracements, and we look again what the market does. Now the market does a bigger retracement, so I need to think like, okay, maybe the market wants to do either this kind of retracement maybe, and then wants to go down. And if I can see that the market wants to go do this kind of retracement and maybe goes down into this low, then it's actually about like, okay, this is actually a $600 movement trading to this high. So the question is now, how big are the retracement? Oh, I can see that the market did this kind of retracement. And then if you just copy this square and you let it within the same length here, for example, like from here to there, it has almost the same retracement. So assuming the market does here the same retracement, again, check this out. If I'm adjusting this one here, or even here without the spikes, just a bit like here, you can see here the market does the same retracement here again. So taking now a red and a green candle, or just what I really love is a higher low, because if the market goes up, concentrating only on higher lows, or if the market goes down on lower highs. A higher low is a red and a green candle, and again a red and a green candle because it's that small. Check this out. Because the market did this kind of movement up for once, did this kind of movement up for twice, did this kind of movement minimum for a third time. Like this is the minimum movement, what is actually pretty cool, and it's very fresh. To assume that the market will do the same movement, cool. So that means aiming for this high makes sense. Trading here a higher low, red green to red green is cool. Entering the trade after the green candle, cool. Aiming for this high gives us a risk reward ratio of 5. That means I have $100 in risk that I can lose maximum, and I have $500 that I want to gain for a winning trade. Sadly, this trade here doesn't work out. We can see here literally that the market tries in multiple times to go up and then it goes against us. We will need to close the trade break even. It means like if the market, if we can see that the trade makes less sense, we can close the trade maybe at $50 or maybe at $25 or even at 0 or small losses, trying so good as possible not to get stopped out. Now here, for example, you see here the market does this kind of movement in the contraction phase because this was the highest and the lowest point, and when going one thing inside, it's like this or even like that. I like to take this one because this one is pretty cool here. And you can see even from here to there, it has an average. So when the market does here the average movement again up, this is just a spike from here to there. Now the red candles here are very attractive here or there to aim for this bigger structure low. So when adjusting now for these two red candles that you see here and seeing this momentum here, $100 for this red candle here, maybe not hitting the red candle correctly, but you can see a risk reward ratio of 6. That means using $100, making $600. You can see here, risking $100, making also $600. And even though when coming in late, the risk reward is also around 4+. It's all about quantity, and strategy doesn't mean just this is how to enter now to trade. Strategy also means risk management. Risk management means if I'm going to sit down on the market, I want to see 2 or 3 trades that are working without trading them, to read what the market is telling me what works currently. I want to make sure that I have only maximum 2 losing trades in a row. I want to make sure that if I have a risk reward of 5 and my trade is a profit, I want to make sure so aggressive as possible to take that profit and not to gain more, like a risk reward ratio of 8, 9, or 10 or whatsoever. Hope you can take something out of this video. Wish you all love, good trades. JT out.